Welcome back, everyone. Today I just want to talk quickly about tax loss selling. It's the end of the year. A lot of us have a couple of stocks that have just went south. We're losing money on it. We've lost faith, no conviction in the company anymore because of management or whatever else. The interest rates doesn't really matter. Now's the time. If you decide that you want to part ways with that investment, you can sell it if it's in a non-registered account, and we can write that loss off and use it to offset our capital gains in previous years or even this one. Now, you may have noticed that I said unregistered accounts because, when we make money in a TFSA or RRSP, we're not taxed on it, right? So when we lose money, we're not going to get a benefit for that either because that is only fair. So tax loss selling only works in our unregistered accounts that are fully taxable, and I think this is, yet again, just fair and correct. I am going to take advantage of some tax loss sellings because I have a lot of companies in the red that I can sell and wait to buy back the appropriate amount of time. So I'm going to do that in the future here. It's about the end of the year, so it's time to do that. As many of you know, I sold a investment condo last year, so my tax bill was incredibly high. So when you do the tax loss selling, you can apply the tax loss back up to 3 years. So that is great for me. I'm going to offset some of those gains and make a couple dollars back. And a lot of you are in a similar situation, be it selling real estate or selling investments at a gain. So this might be something you want to look into. I'm just going to touch on it quickly today. So if you want to look at all the rules and regulations, the government of Canada actually has the best site to get the proper information. I'm on the RBC Wealth Management page. Currently, I'll link it in the description. They have a quick write-up, but I think it's pretty good for people who just want to read the basics of it. Here's a good little write-up. So as we all know that in Canada, capital gains is taxed at 50%. So if you had a $20,000 gain on your TELUS stock and you sold it, $10,000 of that would be taxable income. So you would owe $3,500 in tax if you were at the 35% tax bracket. I think that's a popular tax bracket to be at, so it's appropriate. So, I mean, that's a lot of money. But you pocketed $20,000, but you owe the government $3,500. So what we could do is we could do some tax loss selling to offset that. So that's simply how it works. Pretty easy to understand, and it is a good tool for our investors tool belt. If you're not sure how much taxes you're going to be paying this year, just take your income and take a look at the Ontario provincial and the federal tax brackets. You can add them up, and that's how much tax you will be paying in the coming tax season. So you're prepared and you can do the exact math on the gains. You should go out there and do your own research on tax loss selling, but just so you guys know, if you sell a certain security, you're not allowed to buy it back within 30 days, okay? Otherwise, the loss will be mitigated. You're not allowed to claim it. So a way around this would be, let's go back to the telecommunication sector. Say you have a big loss on TELUS and you want to sell it for the tax loss harvest. Okay, you go ahead and do that. Now, like I said, you can't buy TELUS back, but you can buy a similar company back. So what would we do? We'd go and we'd look for a company in the telecommunications industry again, and that would be Bell, and they have a similar yield, Bell being higher. If all checks out and you like Bell, you could put your money into Bell and you could avoid that 30-day waiting period. So that's just a little workaround, a way to do things a little bit differently. Some of you may not have thought about that, but that's a strategy you may want to use. Anyways, that's the video for today, guys. We'll see you next time. Thanks for watching.